So today's topic is non-resident sellers and non-resident buyers. My name is John Poletes. I'm a real estate lawyer in Toronto. So the first thing I want to talk about is Section 116 clearance. So what is Section 116? Does anyone know what it is?
I was going to say withholding related to non-residents.
Withholding of what? You're getting warmer.
Proceeds of a sale when you're not a resident.
You're getting so warm you're almost hot. You're very warm. Where does Section 116? Where is it?
In the Income Tax Act, I would assume.
Yeah, it's the Income Tax Act. Income Tax Act is a pretty thick book, and the Income Tax Act, if we had a simple tax system like people were talking about in the States, there was a guy a while ago, Ross Perot, who wanted to have a flat tax and no deductions. Things would be very simple, but our tax system is very complex for various policy reasons, and for the problem with our Income Tax Act is the definitions are kind of fuzzy at some times. So Section 116 clearance, who needs it, who pays it, and who is responsible. So this is what I want to talk about, Section 116, and this is a form of non-resident tax for sellers. Okay, so Section 116 is based on international tax treaties. So if you're a resident of another country, does that country have a tax treaty with Canada? So does anyone from another country originally? Do you wonder if your country has a tax treaty with Canada? So let me rhyme off a few countries that I've looked up that have tax treaties with Canada. So the USA for sure has a tax treaty with Canada. How about Mexico? Mexico has a tax treaty with Canada. Do you think Russia has a tax treaty with Canada? Does anyone from Russia? No one? Russia does have a tax treaty with Canada. I've looked it up. How about Iran? Does Iran have a tax treaty with Canada? It does. It does. Almost every country is a signatory of tax treaties, international tax treaties. So these tax treaties were put into place to stop double taxation, because without a tax treaty, you'd be taxed in both countries at the rate of your respective countries. So what these tax treaties say is that if you're a resident of a country, you're going to be taxed according to the residency of that country or according to your own country's rules. So in the United States, they tax on all of a person's income, international income, just as Canada does, but they also tax you on non-resident income, where Canada doesn't tax you on non-resident income. So if you're not a resident of Canada, you don't have to pay income tax in Canada, but you do have to file a tax return. This is if you're in a country with a tax treaty. So what Canada does is it has a rule in our Income Tax Act that if you're selling property that you own in Canada, there's a withholding tax if you're a non-resident. Tax is a good thing. If you're Canadian and you have someone who's a non-resident, shouldn't they be paying tax on money they make in Canada? So imagine, I'm going to give you an example. We had a couple from the United States who bought a house in Forest Hill 20 years ago. And when they sold the house, we had to do a withholding tax. The withholding tax on the house was 25%, 25% of the value of the house. The house was a $2 million house. How much was the withholding tax?
$500K.
Yeah, that's easy, right? Is it a good thing? What is that? Why is that money withheld? It's withheld it's supposed to be withheld by the buyer's lawyer. Usually it's withheld by the seller's lawyer to satisfy any tax that they're owing, because they've made a lot of money on their investment in Forest Hill. Does that make sense? And our government says, you know what, there may be tax owing. We're not going to let them get away without paying any tax. And once they're out of jurisdiction, how are we going to get control of this? So it's a way for CRA to enforce tax while the money's here. Once the money's left the country, how can they enforce it? They're going to send a letter, and they're going to get the letter returned to sender. Return to sender, address unknown, right? Especially when you're owing $500,000. So let me show you the definition of a resident or not a non-resident. So what is a resident in Canada? How do we determine residency? So in the Income Tax Act, we do not have a definition of resident. The Income Tax Act refers to being not a non-resident, but it doesn't refer to being a resident. And this creates a lot of confusion because what's happened over the years is courts have made determinations of what residency is and what residency isn't. Yeah, so basically, the most common definition that I hear for resident is 6 months. That's the most common definition. This definition is used by people, but it's not determinative of what a resident is. It's one of the many things that are looked at. What other things are looked at to decide if someone's a resident? Can you be a resident of Canada and not be a Canadian citizen? Can you be a resident for tax without having citizenship?
Yeah.
Yes.
Possibly,
Yes.
yeah. You start filing a tax return, you say I'm a resident. Can you be a resident? Can you be a non-resident of Canada and have a home in Canada?
Yes.
Yes.
It's a little harder, right? So what's happened over the years is courts have made a test, and we call this a substantial connection test. This is what makes things very confusing, because unless you look at a lot of factors, you're not going to know what a resident is. So the most common factor is how many days are you living in Canada? If you have health insurance, if you have economic ties, if you have Canadian bank accounts, if you're married to someone in Canada, if you have a Canadian driver's license or passport or a home, or if you're holding it as citizenship. So really, what am I telling you? Any one of these may make you a resident. Why does Canada want you to be a resident? So they can tax you. Residents get taxed, and we have a very high tax rate. Would you rather be a resident of Monaco? Would you rather be a resident of Grand Cayman Islands? Or would you rather be a resident of Canada? What is the tax rate in Monaco? Is there income tax in Monaco? There's zero income tax in Monaco. But in Canada, we have a progressive tax rate that starts low and it gets high pretty fast. So if you're making over 100, 150,000 in Canada, what rate of tax are you paying? Over half. Half of your money is going, and then from the half that's left, you're going to pay consumption tax. Consumption tax is HST on anything you buy, okay? So basically, we're taxed a lot if you're a resident. It's easier to be a resident than to be a non-resident for tax purposes. There is also case law that tells us how to become a non-resident. And I'm not going to go into that because that's a little more complicated. But basically, a non-resident is a person who files their income tax in another jurisdiction. And in Canada, they do not file a tax return, or if they do file a tax return in Canada, they're filing a non-resident return. Does that make sense? So what am I telling you? I'm telling you that there is a definition based on case law of what is not a non-resident and what is a resident. There's no written definition of what is a resident in the Income Tax Act. Now let's go into the soup. This is the section of the Form 100 that gives us trouble. Okay, so section 17 in Form 100. Has anyone ever read this over?
Yes.
Okay, so this section says that subject to B below, the seller represents and warrants that the seller is not, and on completion will not be a non-resident under the transaction, and the seller shall deliver to the buyer a statutory declaration that the seller is not a non-resident of Canada. Subject to B. B, provided that if the seller is not a non-resident, you see they don't use the word resident anywhere. If the seller is not a non-resident, under the non-residency provisions of the Income Tax Act, the buyer shall be credited towards the purchase price with the amount if any, necessary for the buyer to pay Minister of National Revenue and to satisfy the buyer's liability of tax payable by seller under this non-residency provision of the Income Tax Act by reason of this sale. The buyer shall not claim such credit if the seller delivers on completion the prescribed certificate. What is the prescribed certificate? So if I'm a buyer and on the closing day, the seller does not give me the prescribed certificate, what am I entitled to do? I'm entitled to deduct from the purchase price and be credited an amount necessary to pay the Minister of National Revenue to satisfy the buyer's liability. Why do we have liability, buyer? Because there's a missing piece of the puzzle. I haven't told you why we have liability, but it's referring to it here. This part of the agreement of purchase and sale is designed to protect buyers. Is it bad? Is it good? It's actually a very good section. This is section 116.5 of the Income Tax Act. So in this section, we're going to find out why the buyer has a liability. Where in a taxation year, a purchaser has acquired from a non-resident any taxable Canadian property of the non-resident person, the purchaser, unless after reasonable inquiry, the purchaser has no reason to believe that the non-resident person was not resident in Canada. Subsection 5.01 applies to the acquisition, or a certificate under subsection 116.4 has been issued. This certificate we call a clearance certificate. The purchaser is liable to pay and shall remit to Receiver General within 30 days after the end of the month in which the purchaser acquired the property as tax under this part of the year on behalf of the non-resident person, 25% of the amount, if any, by which the cost to the purchaser of the property so acquired. Wow, what does that mean? Can anyone interpret this statutory language? It is English, but it doesn't sound too English, does it?
Yeah. So basically, does it mean that the buyer would be liable to pay 25% if the seller turns out to be a non-resident and the certificate is not provided?
Yeah, so who said that?
Ali?
Ali, bingo. Ali, bingo, you got it. Say that again.
Okay, so if the seller turns out to be a non-resident, the buyer would be liable to pay 25% penalty or a tax.
Okay, did everyone hear that? So in the example of my non-resident Americans with the house in Forest Hill, if you were buying from them, what would be your burden if you didn't get the right document?
25% of the purchase price.
And remember, the price was 2 million. How much is the burden on the buyer?
500,000.
Yeah. Is that big? This was almost 6 years ago or 7 years ago this happened. The house now is probably worth 5 million. But at the time it was a couple $1 million. I think it was 2.5. I just round it down for simplicity so we can calculate it easy. So
John, I have a question here. I'm sorry to interrupt here. So if that's the case and the seller hides the fact that he is a non-resident, what happens? Like,
the buyer has to make reasonable inquiries.
which is it's part of the agreement.
Well, let me tell you how we do reasonable inquiries.
Okay.
So with every purchase that I do, and almost every real estate lawyer does the same thing, they send a document which is called a statutory declaration. It's a sworn statement. for the seller to sign. There's no way for us to look at the guy's tax returns. There's no way for us to go spy on him and see if he's calling people overseas or how many days he's spending in Canada. Because remember that we talked about the substantial connection test. We are not obligated to perform a substantial connection test, but we are obligated to make reasonable inquiries. So a reasonable inquiry has been interpreted that the seller will give us a statutory declaration, a sworn statement. And I'm going to discuss with you the weakness of the statutory declaration. It's a sworn statement signed under oath. If someone signs a sworn statement under oath and it's a false statement, that's a criminal penalty.
Okay, but if the person is a non-resident, how are we gonna impose that penalty and how are we gonna go after them?
We're not obligated to enforce the penalty. I assume that Receiver General, will, if they decide to chase them, the same countries that have tax treaties with Canada also have extradition treaties. So if they sign a sworn statement, potentially our government can issue an extradition warrant and have them brought back to Canada and jailed.
I see. I asked you this question. My accountant called me yesterday, and a couple of his clients had the same scenario. The properties were sold without the.
Let me give you an example to illustrate it. Okay.
Yeah.
So a few years ago, there was a lawyer in British Columbia who accepted a statutory declaration that was signed out of country.
Okay.
Does that mean it's bad? Or what was missing with the statutory declaration is it wasn't commissioned. A person who had to commission it should be someone who had the authority to commission a sworn statement. So in my office, there's only 3 people who can commission. So even when we do the meeting virtually, it'll be me or it'll be the other lawyer, Christina. And we also have a commissioner of oaths, which is a special license. So people have to solemnly swear. And if it's a commissioner of oaths, they have to put their stamp to show when their commission expires. Lawyers are all de facto commissioners in Ontario.
Okay.
So they're in other provinces, I don't know the rules.
So you would commission on behalf of a non-resident sitting in a different country?
I can commission them with a virtual meeting. I can commission the sworn statement. Okay. I'm allowed to do that. That's under our new rules. But in this case, in the guy from BC case, after the closing, the purchaser was sent a bill, and the bill was a large amount of money. Let's say it was $500,000. They sent a bill, CRA sent them a bill, and then CRA registered a lien on their property for $500,000.
Okay.
So then they tried to cut. Yeah, I got your attention now. Lien for $500,000, right?
Okay. Question is, so in this scenario that you mentioned, the lawyer didn't do their job properly. Am I right?
Well, let me finish the story. So they went to the lawyer and he said to them, why don't you claim on title insurance? Guess what? This is an exclusion to title insurance. Title insurance does not cover purchasing from non-resident sellers where the lawyer makes a mistake. So that lawyer ended up being personally liable for that $500,000. I assume that his Law Society insurance covered it. I don't know. But that buyer was compensated from that lawyer, directly or indirectly.
And it's Robert, just a quick question.
Anyone can make a mistake, but that's a big wake-up call. But can you imagine the stress that buyer went through until he got compensated? He had a mortgage on his house from CRA. Because of this provision, this section 116.5 creates a reverse onus. Okay, Let me illustrate this a little further. So the people who were from United States, they were honest people, but they were in debt. And the $2 million house had a mortgage of about $1.8 million on it. So to do the closing, how do I withhold 25%? Do I withhold 25% of the proceeds, or do I withhold 25% of the sale price? What does the act say? What does the Income Tax Act say? If I'm withholding 25% of the proceeds, I have to withhold 500,000, but the proceeds are only 200,000. They had $1.8 million mortgage.
Okay.
Hello, John, this is Gulnara. Can you hear me?
Yeah, so let me finish my question to you. So, so the problem now is, how do I finish the closing?
Because I think that sellers are responsible to pay 20% of the selling
25%,
price.
they are responsible, but how do I finish the closing when the money isn't there? These people are almost bankrupt in the States.
Yes. This is a question.
This is a big problem, and this was a problem for us. So normally I would give it, my seller would give an undertaking, or I would give an undertaking to hold back 25% of the sale price. So instead I gave the buyer an undertaking to withhold 25% of the net proceeds. Is that a problem? Does the buyer still have liability now?
I would definitely have.
They have to, it has to be proof that is net proceed of the sale. The document must be enough to show that it's net.
Let's go back and look at what the act says. What does the act say? The purchaser is liable to pay and shall remit to Receiver General within 30 days after the end of the month in which the purchaser acquired the property as tax under this part for the year on behalf of the non-resident person, 25% of the amount, if any, by which the cost to the purchase of the property so acquired. So that's the whole price. It doesn't say net anywhere. There's only one other option. The other option is to apply for the clearance certificate in advance. That's what my client should have done. They should have applied for the clearance certificate in advance, and instead we decided to play a little game on the buyer's lawyer. You want your lawyer to be on your side. You remember who I work for. I work for my client. I don't work for the other side. So we reworded the undertaking, and in this case, I actually took a big liberty here. I'm making up this story. It's not a real story. But if this purchaser closed with such an undertaking, this purchaser would have been in the soup. Can you imagine? If the purchaser gets a bill for the 500,000, the only other option would have been to get the certificate in advance. To get a non-resident clearance certificate, you need an agreement of purchase and sale. So from the day you do the agreement, your accountant can apply for a non-resident clearance certificate. I think this answers a lot of questions. Does anyone have any other questions about this?
Yeah, I have a question. So is that a standard procedure to send this statutory declaration to in every transaction? Because what if the seller is not declaring that he's a non-resident? What's the process?
If the seller is lying, you mean?
Yeah, if they don't, or they might not know.
I can't control it if the seller is lying, but if we have actual knowledge that he's a non-resident, then we shouldn't accept the statutory declaration. But as a lawyer, you cannot swear a statutory declaration for your client unless you verify with them that they know what they're saying. And quite often we'll ask people if they're doing, like, really ask yourself this question. Ask yourself, is it easier to be a non-resident or is it easier to be a resident? It's very hard to become a non-resident. Okay, I've had clients who are truly non-residents. They have no relationship to Canada, and they bought real estate in Canada just for the purpose of flipping it. They bought pre-construction condos.
Okay.
That was clear, and we gave the undertaking and we held back the amount. Does that make sense? Mind you, a lot of people are in Canada. I have someone now who is planning to leave the country because her husband got a job in Geneva, Switzerland. So they're going to sell their family home. She's winding up her affairs here, and she's moving to Geneva. So is she a non-resident or is she a resident? Up to now, she's been a resident for 25 years, living in the same house.
I think it depends on when the deal will be processed. They should be.
There's actually case law for this. What CRA says is when you become a non-resident when you develop a settled intention to leave Canada. When you develop a settled intention, so she may be a non-resident already, which means we should do a withholding for her. But that's kind of a fine line. But the other choice is just get the non-resident clearance certificate, apply for it in advance from Minister of Finance, and you can supply it to the buyer. And the buyer doesn't have to get the statutory declaration. All they need is the non-resident clearance certificate. And usually it takes 1 to 2 months to get it. Now with COVID, I don't know if it takes longer. But Minister of Finance cooperates very well in supplying us these non-resident clearance certificates. And usually we need an accountant to do this because he does like a tax return, a non-resident return. So what I wanted you to remember from this topic is the definition of resident. There is no resident definition. And the definition the only definition we have is what is not a non-resident. Not a non-resident equals resident as far as we're concerned. It's very difficult to determine what is a non-resident, but there is a substantial connection test. Okay, this is not a black and white situation. It's not an easy definition, and it requires discussion. So this is where a lot of confusion is created. This is our main topic. So I should be about halfway through now. Our main topic is non-resident speculation tax. How is this related to non-resident seller tax?
Sorry, John, can I just ask a quick question before you jump topics?
Yeah.
Hi, it's Robert. So I was just wondering about the scenario where you're selling a non-resident's home and they have a tenant and there's been obviously rent collected. How does that impact the transaction with respect to the withholding tax that's should have been potentially taken from the rent, but wasn't? Does that?
It doesn't change it at all because you still need a clearance certificate.
Is it different if it's rented?
It won't matter at all. It will matter to the tenant because the tenant is also under an obligation to withhold. So
how does that impact the liability side of it in terms
of the buyer or of the tenant?
I'm asking. I don't know.
The tenant and the buyer have liability
on rental income as well. You're saying?
Yes. Yeah, it's exactly right. There's a withholding obligation unless there's a clearance certificate. But the reality is most non-residents that have rental properties are already doing a non-resident tax return.
I would disagree with you on that. That's not my experience at all.
So how are they reporting the Canadian income in Canada?
They're not. There are many realtors that are managing these properties and not withholding. I can guarantee you that if you.
It's not for the realtor to withhold. The person who's a non-resident of Canada should still be doing a Canadian tax return. And there's two types of Canadian tax returns. There's a resident and a non-resident return.
No, I'm very familiar with this because I do the withholding for my management clients that are non-residents. I'm asking because I'm dealing with this, quite extensively. So my question is, how does So how does that happen? What's different from the transaction that you would, let's say on a sale, if the person was a landlord as well? And you know, you're taking on this obligation to do the sale, and the purchaser doesn't want to have another obligation of this.
Once there's a clearance certificate, it gets, there's an audit that happens, and they'll look at the rent that the person collected. So if someone is collecting rent in Canada, they'll have a bank account, and there will be an audit at the end that will cover it all. But really, what I wanted you to take out of, because we're going a little off track now, what I wanted you to take, I'm not talking about tax enforcement. Tax enforcement.
Neki az olmadı bu para dige.
Yeah, there's some people that don't have their mics muted,
Parece.
and they're talking on the phone, right? So
I'll take care of it.
So what I wanted to do, what I wanted you to be aware of, is that there is a definition under
Ziyad نگذاشتم یه لاین آزوب گذاشتم
Who is that keeps unmuting themselves? Guys, if you're not going to ask questions, can you mute, please? Okay. Sorry about that, John.
Okay, we can do a mute all too, temporarily, right? If you want to.
Yes, but if you want people to interact, then it's hard.
I want them to unmute themselves when they interact. So basically, Robert, I'm not interested in tax enforcement. That's not our topic. We have two topics that sound similar, but they're very different. One is non-resident speculation tax, and the other one is a non-resident seller tax, which I call a Section 116.
Yeah. Sorry, I'm not talking about enforcement here. I'm just talking about the liability. Is there additional liability on the purchaser? You said there's definitely liability on the sales side of it.
The purchaser's liability is limited to what I'm showing you on the screen now.
Okay, fine.
It's 25%. Okay, it's 25% of the price. That's the purchaser's liability. But if there was a tax liability for rent collected, that would be dealt with when the Section 116 clearance certificate was issued. Okay, so that would be part of the return the accountant does. He would clarify that. Okay.
Okay, thank you.
So let's go to non-resident speculation tax, and this is where my eyebrows get raised. Okay, NRST. So what is NRST? Who is affected? Where does it exist? And what types of properties does it apply to? So this is a law that came in, I think it came in 2017, in the spring of 2017. Does everyone remember this law when it came in?
Yes.
And if you remember the preceding year, 2016, there was a lot of action in real estate. It was a similar market to now. Multiple offers, prices were going up month over month, wasn't it? Do you remember that, 2016? Anyone old enough to remember? It wasn't that long ago. It was pre-COVID.
Yes, everybody remembers.
The market is still good. So what happened, and that was a time I would go to Starbucks every day. Now I don't go to Starbucks anymore because there's nowhere to sit. And I received an email from a friend of mine, and he says, this is a friend of mine that's very involved with the Liberal Party. At the time we had Premier Kathleen Wynne in power, and she was leading up to an election. And everyone was complaining about the real estate market, about prices going out of control, supply, demand, and so on. So basically, she says, I want advice on how to deal with real estate issues in Toronto and in Ontario. He says, I'm going to give her advice, and these are the 4 options. So my friend was taking a poll. He was polling other real estate lawyers as well as me. And he says, leaving politics aside, I feel a duty to the Premier of Ontario as an Ontarian, regardless of, this is word for word from the email I received, regardless of political party, to give my best advice. And I respect your views, and experience in real estate, how would you advise the Premier of Ontario? So this is, give me advice so I could advise her, right? Some of the options are more supply, affordable housing with incentives, open the green belt. Who wants to open the green belt? Does anyone know that Markham used to be a green belt? It's not a green belt anymore. Targeted intensification. Let's build big towers on Yonge Street, okay? Another option is increase provincial taxes, land transfer taxes. How does that solve real estate issues? It stops people from buying. Property taxes, foreign buyers taxes, or vacant homes. These are things that were happening in British Columbia. So usually one jurisdiction copies another jurisdiction, foreign buyers tax or vacant home taxes. That's what happened in British Columbia just before it happened in Ontario. Their market was on fire and then our market went on fire. Improved regulations for rent controls, less red tape. This will stimulate the market. More people will build rental housing. Or do nothing. Who likes to do nothing? Everyone likes to do nothing. Wait for the market to solve the problem. So whenever the government gets involved, usually one solution creates other problems. A solution to a problem can create 5 other problems, right? Some people say we should have a free market for everything, but we don't have a free market for healthcare. Why should we have a free market for real estate? Does that make sense? Who does the real estate belong to, the government or to the property owners? Right? Does it make sense that the government should be regulating our real estate? So he sent me this email and I was kind of stunned and I wanted to delete it. Who would answer this email? There's 66 people. You can just say you would answer it. And if you did answer it, how would you answer? 1, 2, 3, or 4. This is where you can do chat feedback. I need a little bit of participation.
How about getting rid of the golf courses?
That wasn't on the 1, 2, 3, or 4.
Well, open green belt sounds like a golf course to me.
Well, golf courses are actually golf courses are privately owned. So they're owned by someone. Or at least most unless it's a public golf course.
Mm-hmm.
And if it's a privately owned golf course, they get tax incentives for not developing it. Otherwise, they wouldn't be able to afford to run a golf course. But that wasn't one of the choices. Which of these
Number one would be the choice.
Pardon me, number one, more supply. More supply takes a long time. So basically, I interpret this as a political, Robert says number 4, do nothing. I like number 4 too, right? Because that fits into my political views. Usually when the government starts interfering, it makes a bit of a mess. But I did not want to answer this person. And then I thought, the way he's posed the question isn't fair. Maybe the answer has to be a combination of things. And I will tell you how I answered him. I answered him in a way that wasn't what he expected. And I'm not sure if he was happy with my answer, but I didn't care. All I said to him is, look, it looks like we already have number 4 and it's not working because we have runaway prices. And at that time, in the fall of 2016, I taught a course in Halifax and I had the number 1 agent in Halifax attend my course. It was on a Thursday and Friday. On Friday, he was picking up a van load of non-residents and putting them up in motel rooms. And he was taking them on caravan in the Yarmouth Peninsula to buy houses. He would sell 4 to 5 houses every weekend. Can you imagine? People were flying in to buy houses. So option number 4 was not working. And so I said maybe a combination of options 1 to 3. But why should we pick on non-resident buyers? They weren't the majority of people who were buying. Maybe 10%, 5 to 10% of the closings that I was doing at the time were with non-resident buyers. But I don't think that they were the ones driving the market. The market was driving the market. But what I found true was every single one of the non-resident buyers was borrowing money from a Canadian bank. What is the reason Canadian banks are loaning them money? So they could speculate. There's no reason for banks to loan them money other than the bank wanted to make money on their interest. They're charging them a little more interest, and the bank was saying you could buy with 30% down. No questions asked. So that was the only thing that I found that I had trouble with. I didn't want to tax them. I just didn't understand why the banks were loaning them money. Because if someone came with cash, why should they buy? Really, it was bank lending practices. So let's go back and look at the definition of what is a non-resident for this part of the act. For this act, which is a provincial legislation, where the Income Tax Act is a federal legislation. So this is the law that came out, that Kathleen Wynne came out with, announced. So she announced this law in April 20th, that it would take effect April 20th, 2017. She announced it at the beginning of April, I believe. And it was a tax, 15% tax on anyone buying in the Greater Golden Horseshoe. We all know what it is. It says individuals who are not citizens or permanent residents of Canada or foreign corporations or taxable trustees. This is an amount paid in addition to land transfer tax. This money goes to who? It goes to the provincial government. So on $1 million house, you're going to pay $150,000 in addition on top of the purchase price. So if I'm a non-resident under this rule here, remember this rule? If I'm a non-resident buyer under this rule, I'm doing an income tax return in the United States. I have no connection to Canada other than my parents are here. I don't have a Canadian passport anymore. I don't have a Canadian driver's license. So I'm truly a non-resident for the purpose of income tax. Can I buy a house or condo in Toronto without paying the non-resident tax? That's the question I'm going to ask you. No one wants to answer. Okay, we're going to go to this again. Then I'm going to ask that question again at the end. So this is the amount of tax. This is where the tax applies. So it applies City of Toronto, City of Barrie, Guelph, like quite a broad area. Peterborough. It even touches cottage country in some. It doesn't apply to Muskoka. So if you buy a cottage in Muskoka, it doesn't apply there, but it covers a lot of area. Covers foreign entities, taxable trusts, and foreign nationals. It does not apply to Canadian residents, permanent residents, or Canadian citizens. If you're Canadian citizens with a citizenship card or passport or a birth certificate, it does not apply to you even if you are a non-resident. Does that make sense? So it actually does not cover a lot of people who it could apply to.
How about the protected refugee? If somebody a refugee, now their case become accepted, it's called protected refugee. Are they exempt from this?
Protected persons do have an exemption. I'm going to talk about it in the following slide. But really what I wanted to make clear is even though it's called NRST, it's called non-resident speculation tax in the heading. That's how it started. But in the end, it has nothing to do with non-residents for tax purposes. It has to do with people who are not residents of Canada and people who are Canadian citizens or natural Canadians are totally exempt. Okay.
John, just a quick question. I'm sorry. if a Canadian citizen goes to a different country and starts having a job there for 3-4 years and they want to buy a property, they would never become a non-resident. Is that it?
Okay, tell us your name again.
Ali Hassan.
Ali, you went right into the point I wanted to make, Ali. That's perfect. So say that again. Canadian citizen becomes a non-resident.
And like goes to a different country and gets a job there, and now 4 years after.
And he's got all his ties with Canada. He's filing an income tax return as a non-resident. Does he have to pay the non-resident sales tax when he buys property in Canada as an investment? Who can answer that for Ali?
Did you not say that if you're a Canadian citizen, you don't have to pay the tax?
Absolutely right.
So therefore you're sort of in the best of both worlds.
You could be a non-resident for income tax, but the non-resident sales tax does not apply to you when you're purchasing. The non-resident seller's tax for Section 116 does apply to you when you're selling. One is a provincial legislation. It has different definitions. And the other one is a federal legislation with very different definitions. And the provincial legislation, when they first started announcing this law, it was really a law that I believed was intended to get our government reelected, and it didn't really serve the purpose it was intended to. It did cool off the real estate market for a while until people figured out that it doesn't apply to a lot of people. So Ali's client, who's living in California, has cut his ties with Canada, can come back and buy property in Ontario at any time. And as long as he has a birth certificate or citizenship card, it doesn't apply to him.
Okay, that answers the
question. Does that make sense? So, but there's more exceptions. So I'm going to go over the exceptions with you. There's so many exceptions that it's crazy. It's a crazy amount of exceptions. I kind of wonder who's paying this tax. So in the time that since this tax came out, I think I've had less than 10 times that we've had to pay it. That we've had true non-residents. And of the 10 that we paid it, almost everyone got it back. So there's exceptions and there's rebates. So these are the exceptions. If it's not a residential property, it doesn't apply. There's no tax. If it's not in the region, Greater Golden Horseshoe, remember we said what the Greater Golden Horseshoe is? There's no tax. If the property is transferred to an exempt person, foreign national who's exempt, obviously it's exempt, there's no tax. And if the transferee is a Canadian citizen or a permanent resident, there's no tax, even if they are a non-resident for income tax purposes. Those are two different definitions. One is federal definition, the other one is provincial definition. So let's look at the exceptions. Exemptions means you don't pay it. That means you're never going to pay it. So if you're a nominee, that means you're landed, you're not going to pay it. If you're a refugee, protected person, you're not going to pay it, you can buy property. I need proof. I'm going to fill out a form. I'm going to click a button on TerraView and it's not going to be paid. Or if you're the spouse, even if the spouse is a non-resident, if you're spouse of a resident or a protected person, you're not going to pay it. So that means if you're buying with your spouse and you're a protected person and your spouse is not, then you're not going to pay it. Does that make sense? So to qualify for the exception, you must certify that you will occupy the property as a principal residence. Okay? Does that make sense? Or if you're a Canadian citizen, even if your spouse is not a citizen and has nothing to do with Canada, they're allowed to buy with you without paying the tax. Does that make sense? And the definition of spouse is the definition we have from the Family Law Act. Okay, so it also covers common law spouses. So the first, I gave you a big category of exceptions. It's big. Now a second category is rebates. Rebates is you pay and then you get it back later. Are rebates good? They're not so good, but they're better than nothing, better than paying it and never getting it back. So rebate for international student means you pay the 15%, $500,000 apartment, and you get your money back later. What's the rebate on 500,000? $75,000. It's a fair amount of money. Foreign nationals working in Ontario and foreign national who becomes a permanent resident. These are three different rebates and they follow three very different rules. So foreign national who becomes a permanent resident, you apply to become a permanent resident, you have 4 years to become a permanent resident, and then you can apply. International student, you must be enrolled full-time for 2 years from the time of the closing. Full-time in school, that means 60% of a course load. And the school has to qualify under regulation 70/1/17, Ministry of Training Colleges and Universities Act at a campus located in Ontario. Okay, so that means you pay, and then you have to stay in school for 2 years, and then you apply to get the money back. You get your 75,000 back if you paid on a $500,000 apartment. Foreign national working in Ontario. What does that mean? You have to be a foreign national and you have to work for at least 1 year from the time of the acquisition, full-time paid employment, okay? Not less than 30 hours a week. So it tells us how many hours a week over a 12-month period. So there's three different categories. You have 4 years to become a permanent resident, but that can take up to 4 years, I'm hearing from people, right? Imagine if you come in with an investment visa, okay? When do you become a permanent resident? Or international student, 2 years, or foreign national working in Ontario, 1 year. So if you're on a 1-year contract, you can get your money back after the year. So these are the qualifications for the rebate. You must hold the property exclusively, and you have to move in within 60 days of the closing, okay? If rebate must be applied within 4 years after the NRST became payable. For a foreign national who became a permanent resident, it has to be applied within 90 days after the foreign national became a permanent resident, okay? And they want supporting documentation. I don't follow up on the rebates, but I do know people get it back. So now we're going a little over time, but now I'm going to test you to see if anyone paid attention. So this is where you get to text me back and even answer verbally. So I have at least 5 scenarios that are based on real life situations. I signed my agreement of purchase and sale on April 19th. I'm not a Canadian citizen or permanent resident. Do I have to pay the NRST?
Depends.
Anyone say depends? Anyone say yes?
Depends.
Robert says no. Anyone else say you have to pay or don't pay? I gave you the answer at the bottom of the page.
No.
So the answer is the law
Yes.
came into place on April 20th. So imagine you signed the agreement on April 19th, you're going to close on April 21st. The law exempts deals that were made before April 20th. Okay, so does that apply to you today? Maybe, maybe not. So if you signed a pre-construction deal on April 19th, you would not pay NRST even though it's closing now in 2021. It is possible. I have a few of those. But the idea is if you signed it on April 20th, then you're going to pay. So that was an easy trick question. Okay, let's look at the next one. So the next one is, I am a Canadian citizen living outside of Canada and I wish to purchase land in the Greater Golden Horseshoe region. Will my purchase be subject? Anyone say yes?
No.
Not subject, right? Or is subject?
No.
Everyone's saying no. Oh, lots of no's here. Everyone is saying no. Okay, so if you're a Canadian citizen or permanent
این داره که
resident,
تکس داده باشی یا نه؟
if you're a Canadian citizen, you're not going to pay anything.
You know.
Does that make sense?
Yeah.
It's not relevant whether you live in Canada or not. So remember, we talked about two different definitions. Non-resident for Canadian income tax does not attract non-resident sales tax for purchases in Ontario. As long as you have permanent residency or birth certificate or citizenship card. So I guess if you're Conrad Black, you would have to pay it because he actually quit his Canadian citizenship, didn't he? He gave it up when he became a lord. So he would be considered a non-resident. I don't know. Maybe he has a permanent resident card now. My partner and I are buying a house in Oshawa. I am a citizen of Canada. She is not a citizen or a permanent resident of Canada. Does she have to pay the NRST?
No.
No.
And if she has to pay it, how much?
She doesn't have to
Doesn't
pay.
have to pay it.
Remember, I like to ask trick questions. I ask trick questions all the time.
You've indicated on the bottom that it depends if they're a spouse, even a common law or in-law spouse, but if they're just a partner, they might not get the benefit.
Partner doesn't mean anything. It could be a business partner. If it is a true business partner, okay, what amount of NRST will she have to pay? House in Oshawa, I'm just picking one price, 500,000. How much is the NRST? She's only going on half title.
35,000.
Anyone else?
37,500.
15%.
How much is the non-residence tax on a $500,000 house in Oshawa?
15% of it.
I'm a citizen, and my partner, my business partner, not common law partner, business partner is buying with me. How much is it?
75,000, but if it is a partnership, then 50-50, then half of 75,000.
No, the whole 75. The whole 75 they
The
have.
whole 75, they don't care what fraction it is. And the reason they do that is because people are going to put the partner on at 100% or 99%. Okay? So your partner, if it's a common law partner, it's nothing. So this is a trick question. So if if this partner becomes a nominee, it could be a different story, right? But the whole idea is spouses can qualify. If it's a spouse, if you're married or common law, they will qualify for the exemption. But if it's a partner that doesn't qualify under spouse, then it's a partner. Then they have to pay. So let's look at one more here. I don't want to take up too much time, but I think you're getting it, that these rules have to be looked at. And the reason I look at them carefully is each time someone asks me if they qualify for a rebate or an exception, I have to ask them more questions because people never give us the whole story. So I try to get the story in writing from your client, and then I reply to them in writing so they know if they qualify or not. The whole idea is they have to know if they can buy or not. I'm not going to say maybe you can qualify because the non-resident sales tax is a large amount of money. It's a huge amount of money. So here's one. I'm buying a house in Mississauga and I'm not a Canadian citizen or a Canadian resident. I've applied to become a permanent resident and hope to complete the process. Do I have to pay the NRST?
Do I, Sam?
Anyone say no?
You have to pay.
Absolutely, you have to pay it. But can you get it back?
Yes.
Yes.
In 4 years.
Yes.
If you qualify for the rebate, once you become a permanent resident,
Hello.
qualified for the rebate, you have to move in within 60 days of the closing. A common question that I get from people is, I bought a house and it's rented, and after I get the tenant out, I'm going to move in. Then they won't qualify for the rebate. They shouldn't be looking at rented properties. Oh, the tenant said they're going to move. If they don't move, they're going to pay extra money. No one's going to like that. Does that make sense? This is about students. So my daughter is going to be attending university. She wants to buy a home in Toronto while she attends university. Does she have to pay NRST? And can she get it back? How can she qualify to get it back? Can I hold title with my daughter if I don't trust her? Maybe she'll sell it. Maybe she'll move in with her boyfriend and then kick me out of my investment. So what does the rule say? Following conditions. The home must be purchased only by the daughter or the student and their eligible spouse. Neither you or anyone else should have a beneficial interest in the house. You can't do a trust agreement and say you're holding the money in trust for me. You could have a mortgage though, but you can't have a trust agreement. She must be enrolled in an approved school. So guess what question that I get often? My daughter is at McGill and we want to buy a house in Ontario, in Toronto. Do they qualify? McGill is not a qualifying school for the purposes of this legislation because it's Montreal. All right, so I've given you enough of a test. I'm glad that you all passed and you all know how to answer these questions. I will tell you this though, if you do have a client who wants their question answered, I will answer them and give them a responsible answer. All I ask is that they do the closing with me at some point, okay? There's one question here from Millicent. I'm not sure if we answered it yet. If a person is a foreign national who has lived in Canada for at least a year and has a work permit, is that person still classified as a non-resident under the Income Tax Act? So remember, there's two different definitions. Income Tax Act has a different definition and foreign buyer's tax has a different definition. So a foreign national living in Canada has a residency permit or has some kind of a work permit. So they're a resident for income tax, but if they're buying a house, they're considered a foreign national.
Oh, right. Okay.
So they're allowed to live here under their work permit. They're going to pay income tax as a Canadian resident, but if they buy a house, they would be a non-resident sales tax, and then they can get the money back after 1 year. Okay.
Okay.
Does that make sense? So we combined both answers, right?
Thank you.
So I hope you all enjoyed this. This is one of the more challenging topics because we play a lot with legal definitions. Everyone knows that I do closings, commercial and residential, wills and estates, buying and selling businesses, franchise law, commercial leases. We know how to help you. We know how to help you, and we can help you be successful in your transaction. All I ask is refer the client to me at some point, and I will help them and take care of their interests. We help people with assignments. We do lots of assignments, and all of my presentations, we try to keep them to about an hour. Okay, so Tina, thank you very much. And
I have a question.
Amazing presentation.
Okay, I will stay for more questions if people want. You don't have to, everyone else doesn't have to stay. We are scheduled again in 1 month's time. Is that right, Tina?
Yes.
But my cell phone
John, I have a
one at a time.
And if I don't answer your question today, I will take your cell, I will take your text or email and answer your question that way if I can't get to your question today. So I'll take a few questions now.
Go ahead, Paula.
Yes, hi. John, regarding the 2-year period that you said the non-resident students that they can purchase, that 2-year must be prior to their purchasing, or the 2-year study can be ahead of them?
So if I have if I have a 3rd-year student on a 4-year program, they won't get the money back unless they qualify for a master's and then do another year.
So it has to be ahead of them. Yeah.
2 years after the closing.
Yes. Yes. Also, I sent email for wheels for somebody. I need return from you. Thank you.
Okay, we'll help you with everything. Do not worry. Anyone else?
Thank you.
Yes, go ahead, Heidi.
Yeah, my question is the present situation today that the agent indicate a presentation offer and put a little note, seller will accept preemptive offer. Is that a regular this time, or are you liable for that, or?
Okay, well, so let me tell you this. Consider a sale like an auction. In an auction, the seller makes up the rules.
Okay.
So unless they say we're not going to accept preemptive offers, you can make a preemptive offer. Even if they say we're not going to accept preemptive offers, you can still try it and do a bully offer.
Is
So
that right? Okay.
If someone tells you no preemptive offers, you can say, here's a bully offer, and it's up to them to return it to you, right? It's up to them to sign it back. It's up to them to look at it. The reality is the listing agent has no authority to refuse an offer. Only the seller can refuse an offer. So what I do see is sellers are giving listing agents a written direction that they will not accept preemptive offers. And if they give you this written direction that they're not taking it from anyone, then you can assume that you're allowed to do a preemptive offer, even if they say no preemptive offers, even if they say it, right?
Okay.
So really what it does is it creates a very muddy situation. It creates a very confusing situation. If your client wants to make a preemptive offer, let them try, and it's up to the seller to reject it. I had a call on the weekend from a house in Hamilton. Someone's buying in Hamilton, 1.6 million house, and my client says we offered them $1,450,000, and there was another offer, and they rejected them both.
Ooh.
Any pointers? What pointer can I give? Ask for a sign back or give them more money. That's the only pointer you can give. In that case, they were both rejected. They were both looked at. They were rejected for either price or terms. Usually, if the price is okay, they would negotiate the terms, right?
Yeah. Okay. Well, as long as you inform everybody that you will be accepting, reviewing an offer, your liability as a listing agent is justified. Is that right?
Well, the problem is unless you have a written direction from the seller that you're not accepting preemptive offers, someone bringing you an offer will force you to show the offer to your seller. And there's different rules for preemptive offers. So under the rules, under the TRREB rules, and under the RICO rules, you have to notify everyone.
Yeah, normally that's what we normally do.
Everyone who's expressed an interest in the property, and I would also update the listing to show that preemptive offers. So I would email anyone who's shown it, anyone who's made an inquiry, and also update MLS and say we are accepting preemptive offers now, even though you said no.
Schedule. Okay.
Because that's going to put you into a disciplinary situation, right? And you don't want to have that happen.
Of course. Yeah.
Okay. And I've heard of as many as 80 offers on a bungalow. Can you imagine 80 offers? That means 79 people are going to be unhappy. And of that 79 people, some of them are going to complain about their agent or the listing agent. And you don't want to be in that complaint. So always tell your client that if you want to try preemptive, I'll try. But the seller may have given a written direction not to view them, but we can still send a preemptive offer, right?
Okay.
One last question.
I have one more question for Kian.
Yeah, hi. Sorry, this is Beta actually. This is the problem when your child is at home. Yeah, I have a question. So my buyer has bought a pre-construction and he's non-resident, but he has bought it jointly with a resident. And now he wants to assign it before closing. So the 15% tax hasn't been paid to developer yet, and now he wants to assign it. Where does this 15% go? So basically no one is paying it right now, right?
Yeah, the 15% has to be paid on closing.
Yeah, but now the new buyer, let's say the assignee, is a resident.
if the assignee is a resident, you would think, but that seller will still have to give us a section 116 clearance certificate. Right? And I would probably, to be quite honest with you, that's a situation I haven't encountered. I would say if I was a buyer, I wouldn't want to touch this unless I clarified it. There's no reverse onus on the buyer. But it may create some other problems. So I would want to get I would probably want to get an opinion from CRA. And they do give these opinions, 1-800-959-8287. That's the CRA number. You can call them. The opinion they'll give you in writing. So that would be this opinion that CRA gives is called a tax ruling. It's a tax ruling if it applies or not. Okay. So thank you very much, Tina.
No problem. Thank you.
If I missed anyone's questions or if you're too shy, I will accept your email or text. Okay. And my email address is john@homeclosings.ca. All right. Thank you. Take care. Bye-bye.
Bye.
Thank you so much for watching. If you like our video, please hit the like button, the subscribe, and even the little bell to get notifications, just so you can stay in touch and watch more of these great videos.